back. Let's connect with Shyam Srinivasan, who's the MD and CEO of Federal Bank, joining in on the show to talk about numbers and lots more. Mr. Srinivasan, net interest margins at 3.5%. You've revised your guidance to 3.3% now. Can we expect you to further revise your guidance going forward on net interest margins?
Thank you. Yes, Q3 was very good for us on many counts, as you observed. And in particular, NIM's expansion was very encouraging. We all know that to some extent, the NIM expansion has a timing impact of the credit repricing being a little ahead of the deposit repricing. So there's some moderation expected. That said, our full year NIMs will be higher than, on a blended basis, higher than somewhere in the between 335 and maybe on the higher side of that. And that could be the baseline as we go into FY24. For sure, the Q4 numbers will be along the same trajectory from a full year point of view, somewhere in the 335, probably closer to 340.
And what about the other income, which is down 12.5% sequentially? Is there a one-off here?
No, you may have observed in our deck also we have shared, our core fee income has grown quite handsomely, both sequentially and Y-on-Y. The overall other income is slightly lower only because we have made a one-time provision for the entire SR security receipts book, and we zeroized the security receipt book. So there's no future provision. Normally in a quarter, we provide about 12 odd crores. We just upfronted it and provided an additional 48 crores. I think we mentioned it in page 29 of our deck. You will see that. And that explains why the overall other income shows slight reduction. So we upfronted the future provision, which is in the case of an SR, it's an offset to other income as opposed to a provision on the bottom line. I mean, below the operating profit.
Right. Mr. Srinivasan, total deposits have come in healthy at a strong growth of 15% on a year-on-year basis, but still considerably lower than the 20% advances growth, I would say. Which has actually stayed this way for a couple of quarters now. Is that a concern for you? And the timing when you actually see this reverse?
No, I think it's fine. Deposit, I think we've been talking about deposit growth for the industry being a challenge and overall system deposit growth being in the late 9, maybe slightly shy of 10. We are happy that we've been able to grow at 15% and sequentially 6%. So that demonstrates the franchise power of garnering deposits. And as you know, a large part of our deposit franchise is retail. Over 90% of our deposits is retail in nature. So deposit growth is certainly going to be a challenge for the industry, but at a price with our own strengths, we're able to garner deposits. At a CD ratio of about 85% with the credit growth somewhere in the 17-18, deposit growth of 15-16%, I think we are in a good place. So it's a mix and match of all these elements. And I think we for the aspirations we have of between credit growth, the current deposit momentum will hold well.
Right. And what about pricing of deposits? Because your cost of deposits have run up sharply, almost about 25 bips on a sequential basis. How much of the re-rating would you say has already happened on deposit sides and how much more to go? And also, if you could reiterate your NIMs, what is it that you're expecting for the full year?
I think deposit pricing has to be seen in context of credit pricing and the yields being either intact or improving. The credit repricing, as I mentioned, happens earlier and the yields have improved maybe 50-60 basis points, while deposit pricing is beginning to catch up and already half of that has passed through, and in the likelihood in the next quarter another 10 odd basis points increase will happen, and thereby the mix of the business also drives the yield up. Our NIM guidance is never one dimension. It is cost of deposits, is the mix of the business, it's the yield expansion on the new credit, the kind of credit we're writing, the slippages, and therefore the revenue reversal on account of slippage. I think all these play in. All said, I think originally we had thought the year would be about 330 basis points of NIM. We believe that will go closer to 335 or a little higher. And that will serve as the base for FY24.
Okay, so 335 as far as NIM is concerned, and you talked about the pricing as far as deposits is concerned, but talk to us about the pricing when it comes to the corporate portfolio as well, because there are indications that the wholesale portfolio is heating up a tad bit. What kind of growth are you expecting here, and how competitive really is this space now?
We've demonstrated across many segments, many quarters, many years. We are not growth for growth's sake kind of bank. We have grown at 20 odd percent. We have grown at 4, 5, 6%. We have degrown. We have grown at 16, 17%. Very dependent on the market and where we are comfortable in growth. And that's why our credit quality has been, I would think, for many, many, many years consistently, in the gross NPA of 3 or less. We've never had huge volatility on that count. So I don't think we'll compromise credit standards for just to support growth. Within a certain risk appetite, we will be able to grow. And to grow the right segment, if we need to be competitive on pricing, we are happy to be that. We have to manage between NIM, growth, the segment we want to grow, and ensure that the liquidity is there to mix that. That's the equation that we work with. Having said that, when we guide for 16, 18% credit growth in this year, we had said 18 odd percent. I think we're growing at that rate. And we'll see how it goes. The FY24 is still just beginning to pan out. We'll see how it goes, what the environment holds. But gaining share, momentum and growth will continue. We're not going to slack off on that.
Sure. And separately, you have been one of those banks which has been growing quite fast with respect to the fintech partnerships as well. Could you talk to us about how that has translated actually in customer acquisition and how the entire digital adoption is working out for you?
We very early decided fintech is a good way to expand, collaborate, and ensure that our strengths and their strengths work well, which has served us extremely well. We have 4, 5 very productive, volume generating relationships, all going well, and they've had to be readjusted with every RBI regulation coming in. We have been calibrating it to make sure that we are, on the right side of the equation. That's going well. Each of them have bring very unique strengths and distribution and reach into different markets. We believe that our client acquisition amongst all our fintech partners is roughly maybe 3 lakhs a month or plus minus, and that's 30 odd lakh customers a year. Many of them are younger, newer to banking, and therefore, if you take a multi-year view, we're probably building ourselves a great over a 4-5 period. Another federal bank, 1.5 crore customers come into the fold, and over a longer period of time with data and capabilities, our ability to cross-sell and increase penetration ownership in this growing segment will be very high. So we take this a multi-year view, just like the way bank did 25 years back. The NR business for bank appeared like a waste of time, but today that serves us brilliantly. So we've chosen this path to grow this younger segment.
All right. Thank you so much, Mr. Srinivasan, for highlighting those details. That's the management saying that they are happy to be competitive from a pricing perspective, and they are looking at deposit growth faster than system growth. And next quarter, there's going to be close to a 10 basis point hike in deposit costs. FY23 NIMs of about 335 basis points revision. That's Federal Bank, nothing short of a pretty stellar quarter. 142 is where the stock is at. Moving on from banks